So last video number 50, part 50 of this multi-part video series for positional stock traders. I would like to thank you so much for maintaining patience. If you have reached till this video, that means you have got a lot of patience and you have got a lot of discipline as well, discipline and persistence, because it was a lot of content. This is like a course in itself. So I applaud you for that. I commend you for that. Okay. Thank you so much for reaching till here. I wanted to make this the best video in this video series. I took it up as a challenge. I said to myself that the last video should be the best video of this video series. So get ready, my dear friend. Get ready, my dear subscriber. Get ready, my dear student. So if you are enrolled in my video course, that means you are my student officially. If you are subscribed to my channel, then you are my student unofficially. So you are a subscriber. And also, if you are neither a subscriber nor a student, that means you are a trespasser. Trespasser means what? Just, randomly YouTube thought of recommending my little YouTube channel to you, and somehow I landed up on your mobile phone or your laptop or whatever. Somehow this video landed on your lap. So you decided that, okay, let us give this guy a chance. Okay. So you are a trespasser. But if you are a trespasser, you are my new friend. Okay. Coming back to the concept, this is the last video. And I want to teach you something which I have not covered in the previous 49 videos. Okay. I want to talk about the nature of a base and how do you determine whether a base is likely to work out or not. There is a way to do that. Okay, what are the chances that a base breakout will happen? You have to look at the prior uptrend before a base is formed. You have to understand the difference between extended price action and normal price action. So for example, after base 1, the stock should normally go up 20 to 25% before forming base number 2. After base 2, the stock should go up another 20-25% before forming base 3, right? So after base 3, the stock should go up another 20-25% before forming base 4, right? And so on. So that is called as healthy price action. Okay, that is not extended price action. Imagine after base 1, the stock shoots up 200%. We have seen that in stocks, which I have discussed in this video series. There were some stocks which shot up like 200% after base 1. So after that, when the base 2 is formed, is that really a base 2? Was that normal price action or extended price action? That was extended price action. We were waiting for a 20 to 25% move after base 1, and then we would have waited for base 2. But the stock went up like 200% before forming base 2. So that base 2 cannot be called as an early stage base. Okay. Moreover, when a base fails, that does not mean that the trend has failed. See, remember, this is a very important point. I will repeat it twice. Just because a base fails does not mean that the trend has stopped. I will say it again. Just because the base fails does not mean that the trend has stopped. Okay, I will show you on this chart whatever I am saying here. So let me illustrate it with the chart example. Okay, so this is Elecon Engineering weekly time frame chart, and this is May 2022. So it's an old chart. As per SEBI regulations, we are allowed to discuss this chart. Okay, first things first. Now this was marked by MarketSmith as base number 1 consolidation pattern. Don't worry about relative strength. I have already checked the relative strength. It was more than 80. And I have already checked the daily time frame chart. The moving averages were in order. throughout this entire uptrend that I'm going to discuss with you, the moving averages were in our favor on the daily time frame chart. So don't worry about moving averages on the daily time frame chart. Don't worry about the relative strength. That was all in our favor. Just focus here on the weekly time frame chart. In this video, I want to keep your focus on this chart. There is so much that you are going to learn in this video. Okay. So number one, this is a consolidation pattern as marked by Market Smith, and they marked it as base one. Now, question number one, why is this called base one? See, the stock has shot up from here, you see, from the low till here, the stock has gone up 900%. Okay, 900%. Stock has gone up 10 times. How come at that level they call it base one? Because the low of this bar was taken out by this bar. And generally, the bar that takes out that low always comes at low volume. Always means I have seen 9 out of 10 times it comes on low volume. That's called as a shakeout candle or a shakeout bar. So just because of this bar, the entire base has reset. Okay. So from here till here, it could have gone to base 4, base 5. I don't know. I have not counted that. But this is base number one. Okay. In spite of the fact that it has come after the stock has gone up 10 times. So the stock has gone from like 10 rupees to 96 or 100 rupees. That's 10 times move, right? After the stock goes from 10 to 100, how can it become base one? Okay. Because base resetting happens. Okay. The moral of the story here is just because a stock goes up 10 times does not mean that the stock cannot go up even further. As you will see here shortly, the stock continues to climb. And it should not come as a surprise to you now because you are at video number 50. Okay. We have discussed this moral of the story where we have seen stocks go up 200, 300%, and we might think that the stock is extended, but from that level, it continues to go up another 200, 300%. Okay. Here, after a 10 times movement in the stock, 10 times the stock price has gone up, it has created base one. Now, so here at 100, we are not at base number 5 or 6, we are at base number 1 because of this bar. Okay. And the high of this base is 109.50. Okay, the high of this bar is the high of this base. So let me draw a line there, 109.50. I will draw a yellow line. Let me give it thickness. Okay, let me draw this. Okay, so that's the high of the base. This is base one. Now remember what I told you. What is normal price action? After base one, the stock should go up 20 to 25% from the pivot point before it forms base number 2. Okay. So now we will see how much the stock goes up from this yellow line and then determine whether the base has started to form or not. And how will you determine that? Well, you will determine that based on that bar after which you have 3 consecutive bars which are below the high of that bar. Okay. So for example, if you look at this bar, you look at this bar. Okay. After the high of this bar, there are 3 consecutive bars, weekly bars. The entire bars are below the high of this bar. That's the start of a base. Okay, so we need to wait for that candle. Even this candle, see, after this candle, 1, 2, 3. All the 3 bars, the entire bar is below the high of this bar. Okay, that's the start of a base. Now you notice this bar. Yeah, this bar, this green bar. 1, 2, 3. They are not below the high of this bar because this bar high is above the high of this bar. So this bar does not form a base. Even this bar, okay, after this there are only 2 candles, 2 bars after the high of this. Third one goes above this high. So that is not forming a base. So we need to wait for that particular bar after which you have 3 consecutive down bars. Okay. The color could be anything, that doesn't matter. So let's move the price forward. I will quickly move the price forward. You have to tell me which bar. Now you see this bar, after which you have one bar. You need two more bars, but this you see the second bar breaks the high of this. So that bar does not constitute a base. Okay. It does not constitute the beginning of a base. So I will continue to move the price forward till I find that bar. See, now you see here, after this bar, 1, 2, 3. Okay. So after this bar, you have three consecutive weekly bars which are below the high of this bar. That's the start of a base. On Friday, on this week, this bar is confirmed as the bar that we are looking for. Okay. So that's the start of a base. Now, this could be base number 2 depending on the previous price action. So let's see from here till the high of this bar, what's the distance traveled? What are we expecting? 20 to 25%. What do we get from here till here? 80%. What are we expecting? 20 to 25%. What are we getting? 80%. Okay. It could be slightly higher than 20 to 25%, maybe 30, 35%. That is still fine before forming a base. But 80%? 80% is like 4 times what we are expecting, right? If you are expecting a 20-25% move and we are getting like 80%, that's 3 to 4 times higher than what we are expecting. If it's 1.5 times higher, we can still understand, we can still give it some concession. But tell me one thing, is this normal price action or is this extended price action? This is very important for you to understand. If you say this is normal price action, that is a mistake. That is an extended price action. And why do we need to know whether it is normal price action or extended price action? Because if the price action is extended, then base 2 is not early stage in this case. Base 2 could be late in the game. So base 2 might take some time to form, right? So for example, now the stock has gone up 80% before forming base 2, which means the likelihood that this base will fail is higher. Okay, let me repeat that. We were expecting a 20 to 25% up move after base 1. But what did we get? We got 80%. Okay, which is way beyond what we were expecting. So the price has already extended as per our definition. So which means base 2 is not safe to buy now. Just because it is base number 2 doesn't mean that it's an early stage base. Okay, base 2 might take some time, or it should take some time. It should take multiple weeks for the stock to start climbing again. Okay, so now let's see whether this base succeeds or not. So what's the high of this bar? It is 196.98. Let me draw a line there. 196.98. Okay, now let's see whether this base succeeds or fails. What are the chances of failure? The chances of failure are high because it has come after an extended price action. Okay. Let's see what happens next. So it breaks. See, the pivot point has been broken. That's a flat base, by the way. Failed. The base has failed. Okay. From the pivot point, I think it has gone down to 8%. See, it has gone down 20%. Where is our stop loss? 8%, which means our stop loss was hit. That means the base has failed. Correct? So this base that you see, this base is called as base number 2. Okay, base number 2, but it is not early stage base. Okay, now you see, now again, since this base has failed, now again we wait for that candle, after which we get 3 consecutive candles to create base number 2B. This is base number 2A. Base 2 has failed. Obviously, we were expecting that, and it has failed because it came after extended price action. Okay. See, important point to notice here. I am not saying don't buy this base. Okay. I am not saying don't buy the base. All I am saying is that just be aware that you are taking more risk, because when you are aware, you will try to go in with a small position size, or you will be alert, you will be quick in booking your loss. You will not allow the price to go to your 8% stop loss, because you already know that you're coming out of extended price action. The base could fail. I am not saying don't buy this base. I am saying be aware of the risk, because when you are aware of the risk, you can play around with position size and stop loss to control your risk. Okay. Now that this base has failed, we are looking for that next candle, after which you have three consecutive candles which are below the high of that candle. So have a look at this now. Have a look at this. One, two, three. Have a look at this candle. After this candle, there are three consecutive candles. One, two, three. Okay. Which are below the high of this candle. Okay. Which means this candle begins to form base number 2B. Why do I call it base number 2B? Because from base number 2A, the price did not go up 20 to 25%. What do we expect the price to do after it breaks out? We expect the price to go up 20 to 25%. But in this case, that did not happen. Our stop loss was hit, which means the base failed. That is why this is called as base number 2A. This is called a sub base, a base within a base. Okay. And generally, the stock forms three bases. Rarely have I seen uh, four sub bases. So if it is base 2A, it will be 2A, 2B, 2C, and after 2C, the stock would break out. Okay. It will either break out or it will either completely collapse from there. I have not seen base 2D or base 2E. Very rarely. I don't even remember having seen 2D or 3D or 4D or something like that. Okay. One or two stocks there were, I don't remember the name of the stock, but it created four sub bases, but three sub bases are good enough on a weekly time frame chart. So this is base 2A. Now we have base 2B. This candle starts the formation of base 2B. Okay. One, two, three. Okay. Now, what's the high of this bar? 207.80. Now, notice the price has gone below the 10-week simple moving average. Well, that does not mean that the trend has ended. The stock could very well start to pick up from here again, right? Just because it closes below the 10-week simple moving average does not mean that the story of the stock is over. We use that as a signal to sell because we don't know what is going to happen next. It could completely collapse. But for those stocks that don't collapse, if they bounce up from here, go back again above the 10-week simple moving average, the trend could resume. So just because a stock closes below the 10-week simple moving average does not mean that the trend is finished. Just because the base fails does not mean that the trend is over. Okay. So this is base 2B. What's the high of this? 207.80. So let's draw that. 207.80. 207.80. Okay. So this line is base number 1 pivot point. This line is base number 2, 2A, that is a sub base pivot point. And this line is base number 2B pivot point. Okay. Remember, pivot point means then you have to draw the pivot range, the selling range, the stop loss range, which I'm not doing here. Okay, that would be a waste of time because I want to show you a lot of price action here. Now let's see whether base 2B breaks. Okay. And by the way, what are we expecting after base 2B? How much should the stock go up for a healthy normal price action? 20 to 25%. Let's see what happens. And by the way, I am not discussing the nature of the base or the quality of the base here. You see low volume red bars. That is a signal that the trend might not have ended even though the price is trading below the 10-week simple moving average. I am not discussing individual bases in this video. I am discussing the chart as a whole. Okay. That is why this is a very important video. See, the second pivot is breaking. Okay. Let's see what happens next. There's some insect here. Yes. See, it has broken. Let's see where it goes. See, breaks. See, from this yellow line, it has gone up to here, and after that it broke. Let's see how much distance it traveled. 14% only. How much were we expecting? 20 to 25%, which means base number 2B has also failed. Why do you think base number 2B has failed? Well, because of this price action, the stock from base 1 shot up 80%. So base 2 is obviously going to take some time. You don't think that base 2 will form in one single attempt and it will go up. Okay? Chances are very low because the price is already very extended. From here till this base number 2A, the stock should have formed base 2 and base 3, or probably base 4 till it reached here. That is called normal healthy price action. But this was extended price action. That is why you see trouble here. Now look at this bar. Does this bar match our criteria? Yes. See, 1, 2, 3. 3 consecutive bars below this bar. Correct? Below the high of this bar, you have 3 consecutive bars, which means the high of this bar is the next pivot point, okay, which is 238 rupees. So 238 rupees, let me draw that. Okay. So 238 rupees is your base pivot point for base 2C, correct? So this is 2A, 2B and 2C. Now there are 3 consecutive bars below the high of this bar. Okay, let's see how far that base goes. Now I will move the price forward. Let's see when this yellow line breaks. See, now it's taking time. Notice how many weeks are passing, how many days are passing, how many months are passing. Okay, from November, see, this is November till April. So we have gone ahead 4 months. So it is still taking time to create that base. So the moral of the story is, the more extended the price action, the more time it might take to consolidate if it were to continue further. Let me repeat that. The more extended the price action, the more time it might take to complete the next proper base. Okay, because it needs that time to rest, because it already traveled it 80% in a very, very short period of time. See, time and price element both are important. If it goes up like 80% in let's say 1 year, that may not be extended price action because it took some time to reach there. But if it takes like 2 months, like 1, 2, 3, 4, 5, 6, 7, 8, if it goes up 80% in 2 months, that is extended price action. See, time and price element both you have to look at. What is extended price action? 80% in 2 months or 80% in 1 year for a normal growth stock? Okay, 80% in 2 months is very extended price action. By the way, even 80% in 1 year is extended price action, because getting 80% return from a stock is not easy in 1 year. Correct? Even that would be termed as an extended price action. But still, 80% in 2 months is too much. So the stock will obviously going to take some time to consolidate. And look what happens now. It is coming closer to breaking that. Yes, now it breaks. So now base 2A, 2B, 2C, and it breaks that pivot level. Okay. See, the low high of this candle is 236.88. This is 238. That means this is still the high, and this high is lower than this high. So this is a proper cup with handle with the high of this bar as the pivot point. So 236.88. So I will adjust this 236.88. That's the correct pivot point. So you have a flat base, then you again have a flat base, and then you have a cup with handle. Cup with handle is a more reliable pattern than a flat base, because it takes time to form that cup with handle. And this cup with handle is coming at base number 2, which is early stage. Moreover, you have base 2A, 2B, 2C. Generally, after 3 sub bases, the likelihood of failure is less, because the stock has taken time to create 3 sub bases. Okay. And now it is ready to go up. And look what happens. Indeed, it goes up. How much distance are we expecting from that third yellow line there? We are expecting a distance of 20 to 25%. How much are we getting? See, from here, till the high of this bar, okay, this bar, till the high of this bar, we are getting 27%, correct? So within 2 weeks, the breakout week plus 1, 2, within 3 weeks, the target was achieved. Okay, because the stock took some time to form three sub bases. And it was very logical that the stock would take that much time given this 80% move in 2 months. Okay. So if the stock is taking time, it is actually showing constructive price behavior. It is actually showing constructive proper base formation. Okay. So just because it forms base 2A, 2B, 2C doesn't mean that the uh, chart is not going in our favor. In fact, the base is getting better and better. The quality of the base is getting better and better. Okay. And the higher the quality of the base, the more powerful is going to be the breakout. That is why you see in 2 weeks, the target was achieved. Okay. Now, have a look at this bar. After this bar, you have three consecutive bars which are below the high of this bar. Look at the high of this bar, 297. Look at the high of this bar, 299. So again, after this bar, you have three consecutive bars which are below the high of this bar. Correct? Which means this is base number 3. So the high of this bar, which is 299.95, that's your base number 3 because base 1, this is base 1, base 2A, base 2B, and base 2C. It goes up 25% and it forms base number 3. Correct? What's the high of this bar? 299.95. Now tell me, based on what we have discussed till now tell me what is the probability that this base will work out? Well, it's a very high probability that the base will work out, right? Because from base to C, the price did not go up 90% or 70% or 80%. The price went up 27%, 20 to 25%, and then it formed another base, which means it is healthy price action, which means base number 3 in one go, it should give you the return of 20-25%. Base number 3 should not form base 3A, 3B, and 3C. Correct? Agreed or not? See, if you understand this, you have become a professional stock trader. Okay. This is not base counting, by the way. This is already given in market Smith chart. I am not teaching you to count bases. I am teaching you to interpret. I am teaching you to learn which base to buy and which base not to buy, or which base to buy with caution and which base to not buy with caution. So, for example, this base you would buy with caution. You would buy with the awareness that you are taking unnecessary risk, too much risk. This base you should not buy with caution. You should buy with a relaxed mind because you know that exactly after a healthy price action of 20-25%, right, the stock has formed the third base. And look what happened. How much did it go up? From here, from base number 3, it's gone up 20-25%. How many months? Sorry, how many candles? Two candles. Within 2 weeks of the breakout happened here. By the way, all of these bars, the high of all of these 5 bars, 1, 2, 3, 4, 5, the high of all of these bars is below the high of this bar. That's a classic flat base. Correct? In two candles, see, look at this. The high of this bar is 297. This is 298. This is 297. This is 299. Okay. So the high of this bar is the real pivot point. Correct? And look, after the breakout from base 3, within 2 weeks, including the breakout week, both on high volume, the stock shoots up 30%. See, 28%, 28 to 30%. Just 2 weeks. Okay, so this base number 2C and base number 3, base 2C and base number 3 are no-brainer bases, which means there is a very high likelihood that these bases will work out because It is base 2C, it is not 2A, which means you already know that the stock has taken enough time to form that base, which means the probability of a quick breakout reaching the target is very high. And what about base 3? You already know before buying base 3 that the prior trend to form base 3 was a normal and a healthy price action trend. It was not an extended price action trend like it was here. So, which means again the probability that the base breakout happens at base 3 is very high. And that is why in just 2 bars, you get uh, the target. Your target is achieved in 2 bars. That's it. So base 2C and base 3 were absolute no-brainers on this chart. Okay. This is the key knowledge I wanted you to understand. What is the which base to buy, which base to not to buy, which base to buy with awareness of risk, which base to buy aggressively, which base to buy conservatively, which base to buy without giving too much importance to risk. Okay, these things you should know. That you will know when you study the chart properly. Okay, and watch this video twice, thrice till you understand what I am discussing. Now tell me, after this, up till now, whatever you have understood, after this, you expect 20 to 25% movement, after which you want to see base number 4. Correct? Let's see, let's wait for that candle. Is this the bar? No, because this bar has broken the high. So we need that bar after which there are 3 consecutive down bars. Let's see. So now we are hunting for base number 4. See, after this breakout, there is not a single bar after which there are 3 consecutive lower bars except for this candle. Okay. So after this bar, 1, 2, 3, these 3 bars, the entire bar is below the high of this bar. Now tell me, based on your understanding, from base 3, it has gone up to 64%. Okay. Now tell me, is this normal price action or is this extended price action? Obviously, it is extended price action. So now tell me, is this going to be base 4 or is it going to be base 4A? What is the likelihood? Okay, think. This is most likely to be base 4A. So when this base breakout happens, chances are very good that it might fail to create base 4B. Base 4B also might fail to create base 4C. And when base 4C is formed, there is a good chance that the stock might go up. Now, I have not seen what happens after this. Let's move the price forward and see what happens. But you notice what is happening here. The stock first shoots up 900%. Okay. From that level, it shoots up 80%. And from that level, it shoots up another 64%. Correct? So, sorry, 80%, then another 20, 25%, then another 60%. So, don't be under the impression that just because a stock has doubled last year, it cannot go up. Okay, this is the basics of what you learn in William O'Neill's book. Just because the stock has gone up doesn't mean that it cannot go up even further. Okay, so all this idea about buy low, sell high, okay, it's all you have to look at buy high and sell higher. It's a different philosophy altogether because you're trading only growth stocks. You are trading leading stocks in leading industry groups with institutional demand, which have good liquidity, which are within 25% of 52-week high, which are 25% above the 52-week low, which are trading above the 50 and the 200-day simple moving average. In one sentence, I have described the entire filter. Okay, you are only trading in those stocks. So the philosophy is not buy low, sell high. Here the philosophy is buy high and sell higher. Okay, you are buying the stock after it has already gone up 10 times and you continue to make money. Right, from that level it continues to double, even triple. Okay, so the moral of the story is just because a stock goes up does not mean that it will not continue to go up. It can continue to go up. The proof is in front of you. Okay, and by the way, if you want to check the daily time frame chart, go and check the daily time frame chart. For every base breakout, the moving averages on the daily time frame chart were in our favor. You can also check the relative strength of the stock during these periods. I think here the relative strength was in the 80s. Here it must have been somewhere 80, mid 80s, or maybe 90s. I don't know. You can check. But by the way, this is base 4, most likely to be base 4A. So this is 491.50. 491.50. Okay. This is most likely to be base 4A. Let's move the price forward. Let's see what happens. I have not checked. Does it fail or does it go up? Yes, it goes up. See, now the breakout has happened. After this breakout, how much are we expecting healthy price action? 20 to 25% before it forms base number 5. And if that does not happen, then this is confirmed base number 4A. Now have a look at this base. It has taken some time to form this. It has taken multiple months. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. It has taken more than 4 months. So there is a good chance now that this could be base 4. See, you have to understand, whenever you have extended price action, if you form a very short base, that base is unreliable. But when you have extended price action, an extended base, if the base is taking like 4 to 5 months to form the next base, then there is a very good chance that the base might sustain. I mean, it might give you 20 to 25% price rise. By the way, let us check the prices on these bars. What's the high of this? 491.50. This is 493. So see, that high was broken by this bar. Okay. And this is 494. This is 492. So this red bar has broken the high. Okay. That means this base has failed. So this red bar till here, see, it has gone down 12%. So after this high was broken by this red bar, the stock went down 12%, which means the stop loss was hit, which means our prediction that this would be base number 4A, that came true. Correct? So now this red bar, the high of this red bar, which is 494.90, that is base number 4B. Because after this red bar, you have 3 consecutive bars which are below this red bar. Correct? So let's mark that 494.90. 494.90. Okay. So this red bar. Okay. So that is the pivot point of base number 4B, and it was understandable because this move was 60%. So our prediction came true that it is most likely to be base 4A. This is base 4B. Base 4B has broken out now. Base 4B took 1, 2, 3, 4, 5 weeks to form. Okay. 5 weeks to form. This took another 6 or 7 weeks. Sorry, 2 months, 2.5 months, and then here another 1 month. So a lot of time it has taken to form base number 4B. So let's see what happens let's see whether base 4B works. No, base 4B is also not working. See, no, it has only gone up 15%. So which means this price action, this extended price action of 65% has created base 4A which failed. Then it created base 4B which failed. Now the high of this bar, which is 561, this green bar, the high of that bar becomes base number 4C. Now tell me, what are the chances of base 4C working out? 561, right? So let me make it 561. Now tell me, what are the chances of this base working out? Good chance, because now it has gone to base number 4C. Chances are very low that it will form base number 4D. Let's see what happens. I have not checked. So it will either break base 4C or it will collapse completely. See, base 4C has been broken on high volume. Let's see whether base 4C works here. Okay. What is the normal expected price action? 20 to 25%. Failed, failed. See, from here till here, it is 16%. Base 4C has failed. So now this could be base number 4D. Okay. So that is 622.50. 622. See, eventually it will fail somewhere. Okay. So that high has become. See, after that high, there are three consecutive bars which are below this high. Okay. That's base number 4D. 4D has also been broken. Let's see what happens after 4D. It's not working. And by the way, this candle must have broken base 4D. Now you are done with the stock. 12%. Now we are done with the stock. It's not working at all. So this is not proper price action. So it creates base 4A, doesn't go up 20-25%. Then it creates base 4B, doesn't go up 20-25%. Then it creates base 4C, doesn't go up 20-25%. Then it creates base 4D, does not go up 20-25%. So that is not acceptable. We would not spend too much time on this stock anymore. Anyways, base 4 is anyways late in the game. Okay. Now this you could form, sorry, this was base 4A, 4B, 4C, 4D. That could be base number 4E, right? If we keep counting the bases. Anyways, you are not at base 5 because it has not given you that much price. See, it continues to go and break 4E as well. 4E has also been broken, 4F is formed now. Okay. That is too much unhealthy price movement. We need 20 to 25% growth after the base, at least after base number 4C. If a stock is creating multiple sub bases, that is not what we want. We are better off putting our money in some other stock rather than waiting for base 4D and 4E and 4F. We need base number 5, right? So the stock is not moving accordingly. So we started with base 1 here and we reached base number 4E. You could continue to explore further, but you get the point, right? So in this video, you have learned which base is a high quality base, which base you should pay attention to, which base you should ignore, which base you should trade with caution, which base you should trade without caution, which base you should trade aggressively with big position size, which base you should trade with small position size, that is conservatively. Okay. You also learned about what is normal price action, what is extended price action. You learned about what is healthy price action, what is extended price action. You also learned how to properly count the bases on the chart. Now you will understand when you look at MarketSmith, why do they call it base 2A, 2B, 2C and things like that. You also know that you cannot give a stock too much time. After it forms base number 4C, you have to give up on the stock because it's not giving you healthy price action. It is simply wasting your time. Many months are getting wasted. Okay. That is what I wanted to teach you in this last video. So just to summarize our system, let me remove all this. Now it looks clean, right? So before I close the video and the series, let me take you back to the foundation of what I am teaching. This is what I have taught you in this video series. I'll just take 2 minutes to explain. This is what you have learned basically. Now, whether you do it on a weekly chart, daily chart, does not matter. I have repeated this multiple times. You start with filtering, then you do your shortlisting. How will you do your shortlisting? Based on the technical criteria which we had discussed. Start with filtering, then you do your shortlisting. Start with filtering, then you do shortlisting, then you do stock selection with the help of liquidity analysis, comparative analysis, technical analysis, fundamental analysis, and market analysis in that particular order. Okay. And since you are a positional trader, you have to ensure that at least 7 out of 12 of our fundamental criteria are in our favor. Otherwise, it is not a trade, at least for the weekly positional traders. It's a swing trade then, which you cannot take on a weekly time frame chart. Remember, you can take a positional trade on the daily and the weekly time frame chart. Swing trade is something you should not take on a weekly time frame chart. For swing trading, daily time frame chart is more suitable. After you do filtering, shortlisting, stock selection, you determine what is the risk that is being presented to you. Just like when you go to a restaurant, a menu is being presented to you. Similarly, you determine what is the risk that is being presented to you. The market condition will help you determine what should be the ideal position size in this trade. You will decide what is the actual position size that you are going to take. You will wait for a high volume breakout and you will execute the trade with the help of volume, which you will extrapolate on a pro rata basis from Monday, Tuesday, Wednesday, Thursday, Friday. You will acquire your shares, put your stop loss to manage the risk, and then you will manage the trade using the moving average, which I have taught you, selling one third, one third, one third. You will not forget to move your stop loss to break even when you sell the first one third. You will not forget to check the daily time frame chart for moving averages before taking a trade on the weekly time frame chart. That's a summary of whatever I have taught you. Okay, so in the description of this video, you will find this, the link to download this uh, Orange Trading System framework. I have put it as a PDF. Download it, print it, laminate it. Okay, keep it next to your desk so that you do not forget any of these steps. Remember, you have to do this in this particular order. Okay, just ensure that 7 out of 12 of our fundamental criteria are met. Otherwise, it is not a positional trade at all. Okay, I hope this video series has been helpful to you. I recommend that you watch this video series once again. I recommend that you buy a diary. Okay, in that diary, write down the rules for each of these. There is specific criteria which I have already discussed in detail. Write your filtering, shortlisting, and stock selection rules in that diary. Write your trade execution rules in that diary. Write your trade management plan in that diary. Write your risk management strategy in that diary. Write your position sizing strategy in that diary, and keep reviewing that diary till it becomes a part of your system. Then you can dispose of that diary. Okay. You can take a positional trade on the daily and the weekly time frame chart. Many times it is advantageous to take a positional trade on the daily time frame chart because then you get an early entry. But that's a different story. Okay. You become good at this system, trading the weekly time frame charts if you're only interested in this. But in the long run, I recommend that you learn to trade daily time frame as well as weekly time frame chart. You also become good at trading, taking swing trades and positional trades. And you already know what is the difference between swing trading and positional trading. So you have to become a professional at swing trading and professional trading because the system remains the same. The orange trading system does not change. It's a flexible system. You can use this system the way you want. You can tinker with filters. You can tinker with criteria. But the more you tinker, the more you deviate from the criteria that I have given you, the more risk you are taking. As long as you are aware of the risk, it is fine. But if you are tinkering with this system without awareness of increased risk, that is not professionalism. That is not correct. You are increasing risk without being aware of the risk. That is not good for your portfolio. Okay. If you are tinkering with this criteria with the awareness that, okay, I'm taking more risk than what Rohit has recommended. So I would go with a small position size. That is allowed. I will give you forgiveness for that. Okay. Thank you so much for watching this video series. I hope this has been helpful. Watch this video series twice. It will help you more. I will see you in the next video.